A $6 trillion wealth transfer is happening right now, not over years, not gradually. Right now, while most investors are watching oil prices and reading headlines about the Middle East. The US-Iran war that began on February 28, 2026, didn't just disrupt energy markets. It triggered the largest forced reallocation of global capital since the 2008 financial crisis. And the investors who understand the mechanism behind this transfer, the ones who know where the money is moving from and where it's moving to, are positioning for returns that will define the next decade of their financial lives. The investors who don't understand it are about to watch their purchasing power evaporate in ways they won't recognize until it's already gone. Here's exactly what's happening and why the window to position for this transfer is measured in weeks, not months. The paradox nobody is explaining. On March the 2nd, 2026, when Operation Epic Fury struck Iran, global equity markets sold off 4.2%. The S&P 500 dropped 312 points. The Nasdaq fell 6.1%. 2.3 trillion in paper wealth disappeared in 6 hours. Retail investors sold into panic, moved to cash, waited for clarity. Simultaneously, global central banks purchased 47 tons of physical gold. Sovereign wealth funds moved 18 billion into Treasury inflation-protected securities. Chinese state-owned enterprises signed 3 long-term energy contracts denominated in yuan. Institutional money managers at Bridgewater, BlackRock, and sovereign funds in Singapore and Norway quietly rebalanced in ways retail investors cannot access. 2 markets. Same event, opposite responses. The retail market sold in fear. The institutional market repositioned for the structural outcome. That divergence is where the $6 trillion wealth transfer is occurring. Not theft. Transfer. From those who react to headlines to those who understand the mechanism underneath, the mechanism breakdown. The number most investors watch is $100, where oil traded in mid-March. The number that matters is $427 billion, the annual cost increase to global oil importers if crude remains at $100 versus $73 in 2025. That money doesn't disappear. It transfers from oil-importing economies to oil-exporting economies, from consumers to sovereign wealth funds. Step 1. The Strait of Hormuz closes. 20% of global oil supply is disrupted. Insurance costs spike to 7.5% of hull value. Commercial shipping becomes economically unviable. Supply contracts immediately. Step 2. Oil surges from $73 to $126.50. When 20% of supply is removed and demand remains constant, price must rise. U.S. gasoline hits $5.20 per gallon, $6.80 in California. The average household now spends $3,600 annually on gasoline versus $2,400 in 2025. That's $1,200 per household transferred to energy costs. Step 3. Inflation accelerates. Core PCE jumped to 3.1% by January 2026. The energy shock adds 0.6% to 0.9% over 6 months. The Fed's 2% target moves further out of reach. Real yields compress. The 10-year Treasury at 4.25% against 3.1% inflation provides just 1.15% real return. Bonds become wealth destroyers. Step 4. Forced reallocation begins. Institutional investors in 23 trillion of government bonds watch real returns evaporate, accept negative real yields, or reallocate into assets that maintain value when currencies debase. Central banks bought 863 tons of gold in 2025, double the historical average. In 2026's first 2 months, another 187 tons. The buying accelerated after the war. Step 5. The wealth transfer completes. The $6 trillion figure isn't theoretical. It's the calculated shift in portfolio allocation required to maintain purchasing power in a world where energy costs have permanently increased, inflation expectations have been reset higher, and the dollar's purchasing power is declining at an accelerating rate. That $6 trillion moves from cash, from bonds yielding less than inflation, from equities in sectors that cannot pass energy costs to consumers, and into hard assets, energy infrastructure, inflation-protected instruments, and the one asset that has no counterparty risk and cannot be printed by any central bank. The 2 market distinction. The wealth transfer is not uniform. It's happening between two markets responding to the same event differently. The paper market sold everything in early March, stocks down 4.2%. Gold fell from $5,419 to $5,085 despite the war because rising Treasury yields created mechanical headwinds. The paper market is driven by algorithms, leveraged positioning, unwinding during volatility spikes, margin calls, the mechanical relationship between oil, yields, and the dollar. When both rise simultaneously, gold and equities get sold automatically. The physical market told a different story. Physical gold premiums in Asia stayed elevated. Sovereign wealth funds signed long-term energy contracts. Infrastructure funds deployed capital into LNG terminals in stable regions. The physical market positions for inevitable outcomes, not volatility. In every major dislocation over 40 years, the gap between paper and physical markets has never remained permanent. It always closes toward the physical market. Investors who bought physical gold in 1973, when the paper price was falling, captured the 2,300% move through 1980. Those who sold the volatility missed it. The multi-layered mechanism. Layer 1, the energy importers are hemorrhaging capital. Germany, which imports 90% of its oil, is now paying an additional $47 billion annually at $100 oil versus 2025 prices. Japan, importing 95% of its energy, faces a $63 billion annual increase. South Korea, $28 billion. These aren't one-time costs. They're annual structural outflows that continue as long as oil remains elevated. That capital doesn't vanish. It transfers to the nations selling the oil. Saudi Arabia, despite the Hormuz closure reducing its export volume, is still generating revenue at higher per-barrel prices. Norway, a major European supplier outside the conflict zone, is seeing windfall profits. American shale producers are printing cash flow at $100 oil that barely breaks even at $50. Layer 2, the sovereign wealth fund reallocation, is the signal most investors aren't watching. Norway's government pension fund Global, the world's largest sovereign wealth fund at $1.6 trillion, rebalanced in March. Public disclosures won't show the details for months, but the pattern is visible in gold purchases, energy infrastructure investments, and reduced exposure to duration-sensitive government bonds. The Abu Dhabi Investment Authority, the Kuwait Investment Authority, the Saudi Public Investment Fund. These are not retail investors panic selling into volatility. These are multi-generational capital allocators who understand that the current energy crisis is not a two-week event. It's a structural repricing of energy security risk. Layer 3, the dollar's exorbitant privilege, is being tested in real time. For 50 years, the petrodollar system guaranteed structural demand for U.S. dollars because every barrel of oil sold globally was priced in dollars. Countries needed dollars to buy energy. That need created automatic demand for U.S. Treasury bonds, where those dollars were recycled. On March 14, 2026, Iran announced that tankers passing through Hormuz must settle in yuan. The announcement wasn't symbolic. Chinese tankers have been transiting. Indian vessels have negotiated yuan-based passage. The Strait of Hormuz, the choke point through which 20% of global oil flows, has become a de facto yuan settlement zone. The immediate impact is small. A few tankers, a few billion in trade. The structural signal is enormous. If energy can be priced in yuan through the world's most critical oil choke point, the foundational assumption of the petrodollar system that oil requires dollars has been operationally disproven. The system doesn't collapse overnight, but every oil importer watching this is now asking the same question. If we can buy oil in yuan through Hormuz, why do we need to hold $800 billion in dollar reserves? That question, once asked by enough central banks, becomes the mechanism that drives the next phase of de-dollarization. Layer 4, the private sector reallocation, is already underway but hidden from public view. Samsung didn't wait for the war to secure silver supply. They locked in a 2-year exclusive offtake agreement with a Mexican mine, bypassing COMEX entirely. Tesla signed lithium supply contracts directly with Australian miners at fixed prices through 2028. Apple has been building processor fabrication redundancy outside Taiwan since 2024. These aren't emergency measures. These are strategic moves by corporations that understand the difference between just-in-time supply chains optimized for cost and just-in-case supply chains optimized for security. The war didn't create this trend. It accelerated it by 5 years. The historical parallel. In 1973, OPEC quadrupled oil prices from $3 to $12. Stocks sold off. The Dow fell 45% peak to trough. Retail investors who sold and moved to cash watched inflation destroy 12% of purchasing power in 1974 alone. Those who understood the mechanism repositioned into inflation-benefiting assets. Gold rose from $65 in 1973 to $850 by January 1980, a 13x return while inflation destroyed cash and bonds. Real estate investors who bought physical property with fixed-rate mortgages in 1974 watched inflation erode debt while values appreciated. Energy investors who bought oil companies at 1974 lows captured 340% returns by 1980. The investors who profited understood that once energy prices embed into inflation expectations, central banks face an impossible choice: fight inflation with recession-causing rates or accommodate and let it run. In 1979, Volcker raised rates to 20%, crushed inflation, triggered recession. But before that hammer fell, gold made its largest gains because markets priced monetary debasement before the Fed admitted it. In 2026, the setup is identical with one difference. The U.S. carries $36.2 trillion in debt. At 20% rates, annual interest expense alone would be $7.24 trillion larger than total revenue. The Volcker option doesn't exist. The Fed cannot raise rates to 20% without sovereign debt crisis. That constraint is why this wealth transfer will be larger and faster than the 1970s. The institutional signal. What matters most is not what institutions say in CNBC interviews. What matters is what they do with capital when the headlines are screaming panic. JP Morgan maintained its $6,300 per ounce gold target through the March sell-off. Deutsche Bank held its $6,000 target. Goldman Sachs published a research note on March 17th stating that energy security premiums have been structurally repriced and will not revert to pre-war levels even if the conflict ends. These aren't bullish price calls. These are structural assessments from institutions that manage trillions and have access to order flow data retail investors will never see. BlackRock's Alternative Strategies division increased commodity exposure in Q1 2026 by 14%, according to SEC filings. Bridgewater's all-weather fund, the strategy Ray Dalio built to survive any economic environment, rebalanced in February before the war began, increasing gold allocation and reducing long-duration government bonds. These moves weren't based on predicting the Iran war. They were based on recognizing that the macro configuration, high debt, rising energy costs, central bank paralysis, made a monetary regime shift inevitable regardless of the specific catalyst. The sovereign wealth funds are the signal that matters most. Norway's fund bought gold. Singapore's GIC increased real asset exposure. The China Investment Corporation signed energy deals in yuan. These institutions don't trade. They allocate for decades. When they move, they're not reacting to headlines. They're positioning for the endgame they know is coming. The forced choice. The Federal Reserve faces a choice that has no good answer. Hold rates at 3.5% to 3.75% while inflation runs at 3.1% and rising, accepting that real yields are near zero and that savers are being destroyed. Cut rates to support an economy slowing under the weight of $100 oil and $1.03 trillion in annual interest payments, reigniting inflation and confirming that the Fed has lost control. Raise rates to fight inflation, triggering a recession and potentially a debt crisis as $9.2 trillion in maturing Treasury debt must be refinanced at higher costs. Every option transfers wealth. Holding rates transfers wealth from savers to debtors as inflation erodes purchasing power. Cutting rates transfers wealth from dollar holders to hard asset owners as currency debasement accelerates. Raising rates transfers wealth from growth sectors to value sectors and from leveraged entities to those holding cash. There is no neutral path. The question isn't whether wealth transfers. The question is which direction and whether an investor is positioned on the receiving end or the losing end. The two types of investor. One type of investor watched the March sell-off, saw gold fall from $5,519 to $5,085 during a war, concluded the thesis was broken, and sold. They moved to cash yielding 4.5% in money market funds, believing they were being prudent. They're watching their purchasing power erode at 3.1% annually, netting 1.4% real return before taxes. After taxes, they're barely breaking even in real terms. They think they're preserving capital. They're losing the war of attrition against inflation. The other type of investor understands the two-market framework. They recognize the March sell-off as the paper market responding to rising yields and dollar strength, while the physical market held. They watched JP Morgan and Deutsche Bank refuse to lower their targets despite the sell-off. They noted that central banks bought 47 tons of gold on March the 2nd, while retail was panic selling. They understood that the short-term mechanical price driven by treasury yields and algorithmic selling had diverged from the structural price driven by debt levels, central bank behavior, and the mathematical unsustainability of current policy. These investors didn't sell at 5,085s. They recognized it as the accumulation window that the short-term volatility created inside a structural bull market that has not changed direction. They're not betting on gold going up. They're positioning for the mathematical certainty that central banks cannot sustain 3.5% rates against 36.2 trillion in debt, while inflation runs above target indefinitely. When that math forces a policy response, when the Fed is eventually compelled to cut rates or implement yield curve control, or restart quantitative easing under whatever name the next chair chooses, the assets that benefit from monetary debasement will reprice violently. The wealth transfer in motion. The 6 trillion transfer is not a future event. It's happening now in March 2026. It's happening in the sovereign wealth fund rebalancing that won't show up in public filings for months. It's happening in the yuan-denominated energy contracts being signed while Western media focuses on military strikes. It's happening in the physical gold leaving COMEX vaults at elevated rates while the paper price falls. It's happening in the private equity real asset funds being raised at record pace while public equity funds see outflows. Retail investors holding cash and bonds are on the losing side of this transfer. They're earning 4.5% in money markets while inflation runs at 3.1% and rising. They're holding 10-year treasuries yielding 4.25%, while the purchasing power of the dollars those bonds will return in 2036 is being eroded by energy-driven inflation that has been embedded into the system. They think they're being safe. They're being systematically impoverished in real terms. Institutional investors holding real assets, energy infrastructure, inflation-protected securities, physical gold, and non-dollar reserves are on the receiving side. They're not earning 4.5% nominal returns. They're preserving purchasing power in an environment where currencies are being debased by the mathematical necessity of financing debt levels that cannot be sustained at current interest rates. The arithmetic of unsustainability. The United States must refinance $9.2 trillion in maturing debt this fiscal year. At 3.25%, the midpoint of the current Fed funds rate, that debt costs $345 billion annually in interest. At 4.25%, the current 10-year yield, the cost rises to $391 billion. Every 50 basis points the Fed raises costs an additional $46 billion per year. The total federal revenue in 2025 was $4.9 trillion. Interest payments have already reached $1.03 trillion, consuming 21% of all revenue. If rates rise to 5%, interest expense reaches $460 billion annually, consuming 24% of revenue before a single dollar is spent on defense, Social Security, or Medicare. The arithmetic doesn't allow for sustained high rates. The debt level is too large. The deficit is too structural. The political will to cut spending doesn't exist. The math has already made the decision. Rates will eventually come down, not because inflation is defeated, but because the debt cannot be serviced otherwise. That inevitability is what institutions are positioning for. That inevitability is what retail investors ignoring while chasing 4.5% money market yields will discover when the policy pivot arrives and the assets that benefit from debasement reprice in days, not months. The window. The window to position for this transfer is not infinite. It's measured in months, possibly weeks. Once the Fed signals a policy pivot, once the first rate cut is telegraphed, once yield curve control or QE by another name is announced, the repricing will be immediate and violent. Gold moved $276 in a single day during the 1979 Iranian Revolution. Silver jumped 42% in 3 weeks during the March 2026 spike. These moves don't wait for retail confirmation. They happen when institutional positioning is complete and the last marginal buyer arrives. The investors positioned before the pivot capture the full move. The investors waiting for confirmation, waiting for gold to break above $6,000 before they buy, waiting for the Fed to explicitly announce QE before they rotate out of bonds, will enter after the majority of the structural gain has already been distributed to those who understood the mechanism before it became obvious to everyone. This was not a war story. It was not an oil price story. It was a story about the $6 trillion wealth transfer that occurs when energy shocks embed inflation into a system carrying the largest peacetime debt load in history, forcing a central bank to choose between fighting inflation and servicing debt, a choice that has only one mathematical outcome. The wealth is transferring from those who believe 4.5% cash yields are safe to those who understand that safety is measured in purchasing power, not nominal returns. From those holding bonds that will be repaid in debased currency to those holding assets that maintain value when currencies fail. From those watching the paper price to those understanding the structural mechanism. The transfer is in motion. The question every investor must answer is which side of that transfer they are positioned on today, in March 2026, before the mechanism completes and the window closes. Most investors don't know the difference between nominal safety and real purchasing power. Now you do.